Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome back to Surgeon Syndicate. We are here today with the second part of our conversation with Eric Burns. Let's jump right in.
If I wasn't already in the game, it wouldn't have, it never would have crossed my mind. And I think that's, like you said, from the fire department, you did one thing and you're like, that didn't really work out. I'm going to do this thing. It's great that you were in an environment where it was like, well, I'll go try something else. And you got there. So now with what you're doing, where you're raising capital for other people's deals, what would you say to a doc who's like, yeah, I know somebody, they invested in real estate and they lost money, and it happened to a few people over the, when interest rates jumped up. What are the conversations you're having right now with people about what are the things they're afraid of?
Yeah. So they're saying, well, a lot of the interest rate talk, market sentiment is not, or investor sentiment isn't really catching up yet with the kind of deals we're starting to see come through. So strong operators, yeah, they might be hitting tough times, and they might even get a little lower than their projections, but a lot of them are coming out. They're still making money. Even if it's not the projected, it's still close. Capital calls are not uncommon, but at the same time, the dynamics of when they were buying those deals and maybe what they had access to, it's not a reason necessarily to be scared off. That's a more rare event. So as the market will, calm down, whether it hits recession or not, there's going to be really great operators out there buying at discounts. And the reason is that they are taking fixed rate debt, where the floating rate debt, no one expected interest rates to jump so high, so fast.
Mm-hmm.
So yeah, a lot of people are exiting to kind of cut their losses, give investors back as much money as they can. And it doesn't necessarily mean that they're terrible operators or, Bernie Madoffs or anything like that. They just hit tough times. And so Flowers Capital, that's one of the things that I really like to do is get people in my network and in my investor list and really talk to them and say, hey, what areas do you want to learn? And I love writing content. I love writing educational stuff. And I have actually a free ebook on my website that kind of just gives the basic roles and basics of what a syndication looks like. You got a general partnership, you got a limited partnership. One runs it and one gets passive returns is pretty much the breakdown. So having capital calls and things like that, when I go out and I work with my operators, I don't know that I have talked to an operator that in my network that I raised for that isn't poised to really take advantage of the challenging times right now. So there's a market correction, but it's kind of starting to come back full circle where the stronger operators are really able to buy at discounts for the weaker operators that maybe had to take that floating rate debt back then. So long story short, they had great deals at the time. Unforeseen circumstances happened or more extreme than anyone predicted. So a lot of these operators have more than weathered the storm and are really poised to come out looking really well in the future as far as deal flow and returns. A lot of them are vertically integrated with, in-house construction, in-house property management, things like that, and really be able to control the expenses, and kind of be able to kind of offset any unforeseen market fluctuations. And there's ups and downs in any deal, and the operators are there to smooth those out. So As far as being scared off for the future, um, be greedy when people are scared and scared when people are greedy. I think Warren Buffett has just a wealth and wise quotes, and that's one of the good ones. So, but yeah, when people are skittish and the market is quote unquote down, there's great operators out there that are finding great deals. And when things start picking back up, supply and demand numbers are still very favorable. So things will come out with the right operators looking very good. Um, and we do, and one thing Flowers Capital does do really well is have really keep really great operators in a variety of asset classes. And they all react a little differently to the economy too. So, like you said, being able to diversify your holdings inside the real estate sector too is super cool.
So when you're looking at, you talked about good operators and bad operators, and that was, one of the best quotes I remember back in 2009 talking to a builder. And I'm like, oh, this must be really tough right now, as we the single family housing Armageddon. I'm like, what's that like, being a builder right now? And he's like, oh man, it's the best. He said, for the last 10 years, all it took to be a contractor was having a dog in a pickup truck. And so there were all kinds, he's like, like there was so much competition from people who weren't quality builders. And it made the business really difficult. He's like, the only people left right now are quality builders.
Yeah.
And so every once in a while, the market's got to get flushed and the quality stays afloat and everything else gets flushed. So I think we've seen some of that now that, and some of the hard lessons I learned is I think one of the worst deals I invested in back in like 2021, 22, I don't know, was, right in that post-COVID. These guys had a great track record doing self-storage. They jumped into multifamily and it didn't go well, and they didn't handle the downside very well. And when it, and then they didn't even their story after the capital call got even worse because it was like they didn't really. When I was like, I don't know if I want to give you any more money. You don't even seem to realize the mistakes you've made.
Hmm.
And so on the other side now, the guys who have flourished, um, are pretty good operators that are left. So I think that's an interesting point. And talking to people, have you, with the operators you partner with, have there been any operators that, through the higher interest rate times that you've maybe been like, I'm not so sure about you guys anymore? How do you do
Um,
that as you change the network of who you're placing money with?
they are very much being there. Well, I guess the best way to put it is they're just being a lot more selective. So deal flow for them has slowed down. Um, and I know, and actually, I'm really excited because there will be a deal coming through that we'll be raising for here soon. I don't have the details. I'm probably not allowed to talk about it too much, but the operator that is putting it out, um, has been established in their MSA, their submarket, their market for, they have the property management company manages 3 or 4 properties for them alone. I have a sample deal that I based off one of their OMs, and I actually had to scale the numbers down because I didn't want to overpromise, and I wanted to make it more reflective of different market conditions, general market conditions as well. So, and I use that as an example of an operator that closed the deal recently. Um, Conservative, I don't know that they had but 1% rent increase projected, and their exit cap was higher than they're going in. And I thought, okay, this is something I can get on board with. And they were still putting out returns that were as good as 2021, So um, but they have those banking relationships, they have those property managers and construction relationships to really control those costs and make a more predictable run. Coming in with low fixed rate debt is really a benefit that they're enjoying now. Um, Especially since, yeah, I mean, I don't even know what treasury notes are at today. You know, it's like constantly insanity. So
I think
um,
the 5 year is just about 4%.
okay.
So I only
Okay.
know that because I was trying to get a deal done and they wanted to, I think most of them were looking at the 10 year and they were going to base it off a spread off the 5 year treasury. And so we're trying to write up an LOI on Friday and I never spend more time looking at treasury projections going, wow, you didn't even give me a rate. You gave me a thing to, now I see what it's like for the bankers trying to give you a rate. Um,
Yeah,
so
yeah.
real quick,
And when an operator just comes in with good fixed rate, then you get to focus, then you can be comfortable. That financing requirement is predictable. So from there, you can really look in to see what are the dynamics that make this a good deal. The sponsors, the property managers, the stress testing, things like that. And so I'm actually really excited for the months to come, because I've actually been having more positive conversations with operators than I have negative. So as far as are they, the ones I'm working with, are they jammed up? I think they've been sweating a little bit and they've navigated some hurdles, but I think they are becoming very optimistic about the coming months as well. So as we all should be, I guess, you know?
yeah. So go back, you were talking because everybody hears, you don't have to be looking at being a passive investor long before you hear somebody say conservative underwriting, because everybody says they do conservative underwriting. But you mentioned a couple points there that I think are important ones for somebody if they're newer to this in their projections for rent increases and the exit cap rate compared to the entrance cap rate. And I think there are a couple things that uh I'll let you talk about that, your thoughts on why what when if you're reading a prospectus and you look at it, when you look at projected rent increases and purchase cap rate and exit cap rate, what are the things about that that you're like, yes, this is conservative underwriting versus that doesn't look all that conservative to me?
Yeah. So when I look at rent increases, it's generally supply and demand driven. So if they have a lower percentage, 2% rent increase over 3 to 5 years, and then maybe a bump in 6, 7, something like that. Um, it there's usually a reason behind that to make it conservative. For example, maybe they have um, you know, like I know Phoenix has a lot of huge jobs coming online, um, as well as super high demand for the current supply. Even new builds coming online aren't going to keep up with it. So we know that demand is going to be consistent well into the future. So if they're underwriting without a very huge rent bump, so you figure, $50 spread over 100 divided by a percentage gets to be a really big number on the bottom line. So when you're talking about entrance and exit caps, um, that is conservative the way they underwrote that, and that they're expecting to sell in a less favorable market. And I actually have a piece. If anybody finds me on LinkedIn or anything, shoot me a DM because I actually have an entire article I wrote explaining the cap rates, because there's always a confusion and I know it's a confusion because I was confused starting out. What is
Uh-huh.
a uh, properties cap rate versus a market cap rate and things like that? So there are some nuances to that wording, but when it's entrance and exit cap like that, they're referring to the market cap, and they're assuming they're going to be selling in a less favorable market without that much rent increase. And it's like, so that is conservative. Saying that, you know, we made this conservative because we think it'll do better. That's not conservative. That's just perhaps over optimistic. You know,
Yep.
so those numbers need to be driven by supply and demand, costs, and future expectations for online builds and things like that. So when I look at that conservative underwriting, Those are the types of things that make it conservative. Um, just because you think you're over promising or you think you're under promising and over delivering doesn't make it conservative. It just makes it a guess, right? Like,
So yeah. So if they so the what we want to see is that they have a plan where they're gonna either the property's been poorly rented, and so they've got a plan for how they're going to rent it better, or they're going to uh, refurbish the property and make it nicer, and that's how they're going to drive rents. And that's where there was a lot in the last couple of years that post COVID, because of all the rent support, we saw rents going up at, record rates, and now they're flattening off. And so if they just think rents are going to go up and there's not a plan for why people are going to pay more,
hmm
that's kind of a wing and a prayer. Or they think, like you said, they're going to sell it in a more favorable market. You can't control that. And so you see it all the time. Somebody says, "Oh yeah, we're buying it at an 8 cap and we're going to sell it at a 6." And you're like, "Okay, why are you so happy? Is there a reason if the whole market's at 6? Well, maybe. But if somebody's saying, I don't know if I've seen a prospectus in the last 3 years that somebody projected they were going to sell at a worse cap rate than they bought into. I mean,
isn't that
that's
cool?
really getting
Yeah.
conservative. When your deal looks so good, you're like, how many things can go wrong? And you start plugging things in and you're like, it still works. And you plug something else in your spreadsheet and it still works. And you're like, ooh,
hmm
this is good. So, there's where you get to conservative underwriting is you start putting things in your model of what's not going to work. So if you've got a plan that if everything goes perfectly, then A is going to make you money and B is going to make you money and C is going to make you money and D is going to make you money. But you start going back, okay, let's take A out, let's take B out, or
hmm
we only get half of A. That's the ones where then you're like, okay, these guys aren't. If it's all pie in the sky, that's the ones to maybe be a little more concerned about.
Yeah,
What
yeah.
could go wrong.
And honestly, I think my biggest role as a capital raiser in a private equity firm, stewardship of people's money is stewardship is so big, and being able to really look at other people's deals and say, yes, that's conservative. Nope, that's too overly optimistic. I get to pick and choose which deals I raise for. So being able to kind of cherry pick the no-brainers is a nice thing. And having so many great operators in my network and the way that they are able to get so conservative is because they have tried and true systems in their specific market that they have been running successfully through hard and bad times. So, um, good and bad times. So, yeah, that proven track record goes a long way. And you start seeing some of the numbers and you're going, wait a minute, I thought it was supposed to be a bad real estate market. I thought this wasn't a good thing right now. But it's changing and looking forward to investor sentiment catching up, really. Um, and really looking forward to um, as far as like getting into all the underwriting and the complications, that's one thing I do enjoy doing is getting out there and having conversations. Is hey, I wrote an article on this. Let me get you, let me send it to you and then call me back with some questions, and learn together, you know. And if you just want to go completely passive, you know, that's um that's what good operators and capital raisers are there for. You know, the day-to-day headache. That's why I sold all my residential stuff was it's a full-time job even with the property manager. And it's a full-time annoyance even with the property manager, right? So yeah, but to have somebody operating the deal, running the day-to-day, checking out, looking out for your interests and navigate, and ideally a problem comes up and you would get a call, hey, we hit a snag. Here's what we're doing to remedy it. It might be the numbers might not be great for a few quarters, but we think we're going to drive costs down and get it back. I want to never come with a problem and not a solution. And that's what's great about
Yep.
having great operators and having somebody get you in passively is they can do all that for you. And then you get the update. Okay, it's being handled. Let me go on and enjoy this passive income, right? Which is the point.
Yeah. So what do you see as the benefit if somebody's looking and they're like, oh, a private equity company or a capital raiser versus finding sponsors who are raising for their own deal? What's the benefit of one versus the other for the investor?
So a lot of the sponsors that'll raise, well, they will raise for their own deal. So they may, out of a $5 million raise, they may raise a million or two, or they might raise a couple million and bring a capital raiser on for another 2 or 3 million, however they decide to do it. They get to do more deals that way, so that benefits them. Um, and then as so for the investor to go to a big operator like that, their minimum investment might be higher for one. It might be harder to get into for secondly. Um, and one thing about capital raisers, like myself, is being able to have asset classes to get into within commercial real estate to diversify within that sector. They all react a little differently to the market and interest rates and things like that. Supply and demand for different asset classes reacts differently to economic conditions. So to be able to have options within this sector um, and be able to diversify not only between traditional investments and commercial real estate, but also between asset classes, diversify between markets. You may want to multifamily in Phoenix and then say, okay, well, that's a great market. We have another one in Houston. So that's another great market. Things like that, and say, okay, so I have half in Houston, I have half in Phoenix. They're both doing well. Just that diversification, peace of mind, protect your downside.
Okay. And that gives an investor one place to go. They don't have to go find an operator in these different places. If they find a private equity firm that they know and trust, they can accomplish more in that one space.
Yeah, yeah. And there's a lot of operators out there, and to get to know them and really get to know their systems, their demeanor, how they handle problems and things like that, takes
Mm-hmm.
time. So when I get a deal from one of my operators, I'm excited because I know they're good guys. I know they're good operators, guys and gals. I know they're good operators and things like that. So I'm excited to get people into their deals because I know I'm very confident they'll do well. And the reason I'm generally so confident is because I'm confident in the operator. So they've been vetted. There's prior relationships, and a lot of the big benefit too is just leveraging my network, leveraging a capital raisers network to get into those and have, you have a relationship with one capital raiser, you de facto have a relationship with 5 operators in that way. So kind of scalable, really, kind of a way to scale, I guess.
Okay. No, that's great. So if somebody wants to get a hold of you, you talked about a little bit before, you have an ebook. Where is the best place for somebody to reach out to you at?
Yeah, yeah. So I'm on LinkedIn. Um, but the easiest way is flowerscapital.com. And you can join the list or download the free ebook at the top. And I look forward to walking the journey with you if you decide to get in touch. So yeah, I appreciate that.
All right, you're welcome. Any last thing you'd like to share with our audience before we wrap up here?
No, I know there's a lot of doctors on, so um, yeah, hey, doctors out there, financial freedom is for you too, and we look forward to walking that path with you.
All right. Well, thank you so much, Eric. It's been great having you on the show. For everybody listening, thank you for being here, and join us next time on Surgeon Syndicate.
Such a pleasure, Doc. Appreciate it.
Do you care about paying too much in taxes? And would you like to save more of your hard-earned dollars? Here's what we found. We found that most financial professionals have a one-size-fits-all solution. So the question is, would it make it easier for you to have someone tailor your tax solutions to your individual needs so you can keep more of your money and do what you want with it?
That is exactly what we do at Excelstra.
As surgeons, we know the difference between routine surgery versus life-threatening interventions. And I want you to know that I've used Unicia and her team for my personal financial intervention, and I love the results. I would do you a disservice if I didn't recommend them to you.
We'd love to help you, so let's jump on a call and see how we can collaborate. Simply go to www.excelstra.com/McManus and book your free call today.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.